Hello friends, this is Dr. Bhavdeep Ahuja here and I'm continuing with my short series of videos. In this video, I'll be telling you about the types of mutual funds according to various categorization as we all know. So the number one classification is based on asset class. What exactly are the distribution as per that? So as per asset class, the first category is the equity. As I told you in the nomenclature, they basically invest in the stocks of the companies, usually in the stock market in various giving it away exposure. They can be a good rated funds, usually good rated stocks in that sense. So the number two based on asset class are the debt funds. So debt funds basically invest in low risk fixed income products like the G-Secs or also known as the government securities. So they come with a fixed maturity date and so they are ideal for investors with low risk appetite. Then third, based on asset class, are the money market funds. They are the ones which actually deal in cash equivalents or cash equivalent securities and usually are known for returning as regular dividends. So again, a relatively low risk investment and ideal for short term investment. So the fourth category in this is hybrid or balanced funds. You see a lot of ads these days on balanced advantage fund by Kotak and a few others as well, even by ICICI. So they actually invest a certain portion into equity and the rest in debt. The ratio can vary as per fund to fund. So the risk is relatively high than the debt, but lesser than the equity. So the returns are also higher than the debt, but lower than the equity since it is a mixed fund. They always say you come with a strategy of offense and defense totally managed into that. So this is the first categorization based on asset class. The next categorization is based on structure. So structure wise, either they're open ended, close ended, or interval funds. So the open ended mutual funds, they are no constraints. Whenever you can enter, whenever you can exit, anytime you can buy. The close-ended ones come with a say expiry date kind of a thing. They have a deadline. You can invest only till a limited time period, and then their maturity is also fixed in some time. For example, it is a 1,000-day fund. It will automatically expire after, or say be redeemed after 1,000 days. A similar plan can be vary from different. I'm just giving an example of 1,000 fund. So the unit of investments is sometimes fixed that you can't invest below that, and then again you cannot sell sometimes more than a number of predetermined or preset units by the company. So these are a few limitations in closed-ended funds. Then the interval funds, they can also be bought or exit at specific intervals as determined by the company, and then again their investment is also open for a certain amount of period, and then you also need to stay invested in that for a fixed time, maybe 2 years, 3 years, 5 years, as per decided by the company. So this is the categorization based on structure. So the next categorization based on investment objectives. So based on investment objective, the number one option is growth funds. Usually they invest in companies, usually the stocks of companies having giving good or above average growth, and their returns are pretty much high, but their risk is also very high. Then the second option is the income funds. The corpus is actually in the invested in high dividend generating stocks and government securities, and these funds will offer you regular income and impressive returns sometimes if you invest or stay invested for more than 2 years. Then the third category is the liquid funds, usually come with a date of 91 days, and you can maximum put in 10 lakh into them. So then the fourth category is the tax saving funds or the ELSS funds as we say. So they offer the both the advantage of equity and tax saving both. So returns are usually high, sometimes little tad below the pure equity funds, but many of the ELSS feature in the top 10 as well. So but the disadvantage is that because of the tax saving nature under 80C, section 80C, they come with a lock-in of 3 years in them. Then the fifth category is aggressive growth funds. These funds actually have a high level of risk and but are designed to say garner you steep returns as well. They invest primarily in the small caps, which do carry a large amount of risk, but they, in spite of the volatility, has the potential to give you a maximum possible return. So then the sixth option is the capital protection fund. So they invest mainly in debt securities and in equities partly to protect investors' capital, and sometimes a lock-in period is there for 3 years. that you should stay invested, and but the returns offered are pretty much low. The seventh option in this is the pension funds, designed as a specific product for retirement only. So these are the options. If you choose, you have to stay invested for long, but these are designed for meeting contingency expenses like a child's wedding or a medical emergency if that arises. But yes, that is not advisable that you dip into your retirement saving. Then the last or the eighth category is the fixed maturity funds. So these invest in money market, security, bonds, and are close-ended plans actually, and they come with a fixed maturity period, and that can extend from a month to 5 years as well. As I gave you an example of 1000 days, it can be 1500, 1700 days as well, depending upon that. Then the next categorization is based on high risk funds, based on risk profile. High risk funds, medium risk funds, low risk funds, and very low risk funds. So this is basically, the funds are not the same, not categorized separately. Some of the funds may fall in maybe the debt category and the low risk category commonly. They may be a close-ended as well. So this is the way one fund can have all the three characteristics as well. So you need to find out that what suits you accordingly. So then there are some specialized mutual funds, say segregation, or you can say division based on their specialized nature. The number one is the index funds in that. So index funds actually are invested with the comparing with the benchmark set, and they try to replicate the performance of that index only. So the stocks portfolio or the stocks exposure in that fund is actually akin to the same which are there in the index only. So the second category are the sectoral funds. We also call them as the thematic funds. They are theme based fund, for example, power sector, real estate sector, FMCG sector, banking sector. So they are based on different indices. There are different indices in the stock exchange as well. So they try to invest in a specific sector, and the sector may have actually zero growth or almost nil growth, or maybe a gargantuan growth as well. So these funds actually carry a very high risk profile. So then another option is the fund of the funds. So a mutual fund investing in other mutual funds is that fund is known as the fund of the funds. The main aim behind this is to achieve diversification of that fund. So this is the reason that it is known as FOF, or the funds of funds. Then the fourth category is the foreign or the international funds. So they actually invest in the funds which are located outside the investor's country of origin or residence, and they can deliver good returns at times when the Indian stock markets are performing well, or maybe the foreign stock markets are performing well as well. So then the fifth category is the global funds. They invest both in the investor's country and in the foreign country funds. So they are universal and diverse in approach in that ways, but they have a high level of risk due to currency variation, due to different policies, and maybe say a global meltdown, because the same situation does not exist in every country. So then the sixth category is the emerging market funds. They actually invest in the developing markets. They are very risky investment options. So India is also emerging and dynamic market, so the funds are actually subject to market volatilities. Then the real estate sector funds, the seventh type. So these are special shares which invest in the high quality real estate directly or through the companies which purchase real estates. So though these funds have high risk, but they are known to offer long-term returns. So then there are various other funds also in this category, like the market neutral funds, asset allocation funds, gift funds, and the ETFs, or the exchange traded funds, which you all hear these days in relation to gold as well. Or you see the ad of Shikhar Dhawan also, exchange traded fund. What exactly is that? These are ETFs are actually sold and purchased on exchange, offer the exposure to overseas stock market, and they are in the specialized sectors only. They can be traded in real time, and the prices can increase or decrease many times in the day. So but they are low cost, and thus sometimes they are preferred also sometimes. So this is the categorization based on asset class, structure, risk profile, their special characterization, and based upon their investment objectives. So I hope you like this video. Please do like, share, and comment. The next video will be there with you in less than an hour. Thank you so much. Keep watching. Bye bye. Take care.